whatever the amount of debenture is there, same amount has to be calculated, will be retained in the new company also. Goodwill come on the asset side of the balance sheet. If its difference comes to credit side, it is called capital reserve. It will come on the liability side of the balance sheet. Z Limited will pay to X company. Z Limited paid to Y Limited in the form of equity share capital. The assets of X Limited are taken out at reduced valuation. That means they not only they take the book value of the Y Limited. Hello my dear student, I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram, First Grade College, a Temple of Excellence, MYSURU. In this session, I am going to hand Advanced Corporate Accounting 4th semester, Unit 2, Session 3 in favor of merger and acquisition of companies. Already told in the last session, what do you mean by merger? What do you mean by acquisition? This is the third problem which I am going to solve. We'll move on to the problem now. Amalgamation in the nature of merger. We are doing the problem amalgamation in the nature of merger. The following is the financial position of X Limited and Y Limited. There are two companies. One is called X Limited, another is called Y Limited. Land and building, plant and machinery, stock, debt or cash, equity share of ₹100 each, 6% debenture of 10 each, reserve fund, dividend equalization fund, employees provident fund, creditor profit and loss account. The two companies agreed to amalgamate and form a new company called Z Limited. The authorized capital of Z Limited is ₹10 lakh, equity share of 10 each. The assets of X Limited are taken over at reduced value of 10% with the exception of land and building which are accepted book value. This is sentence. So they're taking all the assets and liability. Assets are taken over except building taken at the same value. Other asset taken over at 10% less. Both the companies to receive 5% of the valuation of their respective business as goodwill. So whatever the total asset taken, on the total asset, they are going to pay 5% as a goodwill. The entire purchase price, whatever the amount they are going to pay is called the purchase consideration. The purchase price is to be paid by Z Limited in fully paid shares. In return for debenture in X Limited, debentures of the same amount and denomination. Whatever the amount of debenture is there, same amount has to be calculated, will be retained in the new company also. Calculate the purchase consideration and prepare the opening balance sheet of Z Limited. Now, they take over the assets and liabilities. See that? What's the value of the asset you have got? Land and building remains the same. What is the next one? Plant and machinery. What's the value? 1,10,000. $1,10,000 minus 10% less. 1 lakh 0 followed by 11,000. Deduct 110 minus 99,000. This is the value. It's the value. Same thing to stock. What's the value of the stock? 16,000. Minus 10%. 1,600. This is 16,000. Minus 1,600. 14,000. What is the next one? Machinery over, stock over, then debtors 14,000. Minus 10% less 1,400, 12,600 is the value. Cash remains the same. So, building same value, machinery 10% less, stock 10% less, debtor 10% less, cash remains the same. If you add this figure, it will come 1,59,000. It will retain the same. No change in Y limited. The assets of X limited are taken out at reduced valuation. That means they not only they take the book value of the Y limited. So 50,000, 8,000, 9,000, 1,000, 68,000 minus liabilities taken over. Employees provident fund 3,000, creditor 10,000, 8,000, 6%, debenture 20,000. It become 1 lakh. Here 10 plus 3. This is 20 plus 30, 33 gone means it is 1,26,000. We deduct now. All these will be deducted. All minus figures. So 68,000 minus 8 becomes 60,000. So 5% goodwill on this 1,26,000 will work out 6,300. 5% is 3,000. This is a purchase consideration. This is the amount payable by Z Limited to X Limited and Y Limited. So X and Y Limited are selling here. Two companies, X Limited, another Y Limited. So Z Limited is taking over assets and liabilities of X Limited and assets and liabilities of Y Limited. They are paying the sum price. That price we have called as purchase consideration, which has been paid in the form of equity share. So they take over all the assets of X Limited 10% less regarding the Y. They took at a book value. So amount payable is 1,32,000, another 63,000. Now, how to pass the entry now? First one. So they asked to pass the journal entry in the books of Z Limited, business purchases account debtor to liquidator of X Limited to liquidator of Y Limited. You have to pay X Limited, you have to pay Y Limited. They take over all the assets and liability. Building account debtor, debit what comes in? Machinery account debtor, stock account debtor, debtors account debtor, cash account debtor. The difference is goodwill. The employees provident fund account debtor, creditor account debtor, debenture account debtor to business purchase account. Whatever the difference comes here, this is your balance sheet here. There is no goodwill here. So whatever the asset here taken over, it is 30,000 plus 1,49,000 plus 22,400 plus 21,600 plus 4,000 minus 3,000 minus 18,000 minus 20,000 minus 1,95,300. So there is a difference of 9,300. So when the assets are less, when the liabilities are, if the difference comes to debit side, it's called goodwill. If the difference comes to credit side, it's called capital reserve. When they take over the assets and liability, if there is any difference come on the debit side, it is called the goodwill. If the difference comes to credit side, it is called capital reserve. So goodwill come on the asset side of the balance sheet. If its difference comes to credit side, it is called capital reserve. It will come on the liability side of the balance sheet. How they have been paid? In the form of equity share. Liquidator of X Limited account debtor, liquidator of Y Limited account debtor to equity share capital Z Limited. Z Limited will pay to X company, Z Limited paid to Y Limited in the form of equity share capital. They will put into balance sheet. So if you prepare the balance sheet, on the liability side of the balance sheet, you take the heading like this, share capital and reserve. So the purchase consideration has been paid in the form of equity shares. Then non-current liability, debenture, 20,000, current liability, employee provident fund, creditor. So the total liability work out 2,36,000. Come back to asset side. Non-current assets. Goodwill, it is called intangible asset. Building, fixed asset. Plant and machinery, fixed asset. Come back to current assets. These are all called goodwill, intangible asset, land and building, fixed assets, plant and machinery, fixed asset. Current assets are stock. If you go with the balance sheet, understand stock 22,400, debt are 21,600, cash 4,000. So it will tally for 2,36,300. Very easy. Combine of both assets and liability, the amount has been paid in the form of equity share. So X Limited and Y Limited has been taken over. X Limited, Y Limited, the assets and liabilities of X Limited, the assets and liability of Y Limited taken over by Z Limited. They paid in the form of equity shares. Hope you understand. They take over all assets and liabilities of X Limited and Y Limited. They paid in the form of equity share. So this is a case of amalgamation in the nature of merger. Both the company merged together, form one company called Z Limited. Hope you understand. We'll have some more problem in next session. Till then, goodbye. Meet in the next class.